Well, uh, now we want to discuss about the labor market. So, as we know from our chapter in the beginning, what we discuss about the supply and demand, labor market is also working based on the supply and demand. But there's an important aspect that you have to keep it in mind that in a normal market, when we are talking about the supply and demand, we consider ourselves as a consumer or a buyer, and we consider the firms as a producers or businesses as a producer, and then we try to understand the market forces of supply and demand, how they calculate the equilibrium in the but in the labor market we consider as ourselves as a supplier, because we are supplying labor as a professional, as a working somewhere in other firms and businesses. So we are the supplier, and who are the buyer? The firms, the employers are the buyer. So that is one important aspect we have to keep it in mind while discussing the labor market. Other things very similar to that, the market mechanism. So the labor market for hairstylists. So we are starting with this an example, like what is a labor market. So we are saying that there's a labor market for hairstylist, means the firms who are providing the service of hair cutting or hair saloon, they want to hire people with having a job of doing haircuts or hair styling. So what is bought and sold in a labor market? So buy and sell workers' time. Now labor market is dealing with the workers' time per hour. How many hours the worker is selling and how many hours the employer or the firms are buying. So wage is the price of the labor. The wage is the price, and it depends on the demand and supply. So wage is a price for each hour the worker is willing to sell, and the firms are willing to buy. So this is the way. Quantity access tracks hours. Now, in a standard supply and demand model, we plot quantity supplied and quantity demanded on our x-axis or a horizontal axis, and price on a vertical axis. Now here what we are going to do, we plot the number of hours or the quantity of hours demanded or supplied on x-axis, and on a vertical axis, because price, now the price of the labor is wages, so we plot wages, hourly wages rate, the rate of hourly wages. So this is the way that we have. In the hairstylist labor market, buy labor, purchase an hour of an hair stylist time, and sell labor, hairstylists supply an hour of their time in return for an hourly wage. So if you are a worker, then you are the supplier in the labor market, and equilibrium is where the demand and supply intersect. So we very standard, we all know that this is our demand curve, this one is our demand curve, and this one is our supply curve, and by the interaction of these two we see that the equilibrium is here. So this is going to be the per hour wage, and this is the number of hours that is going to be settled within the market. Now supply curve, the labor market, note the switch. That's what I mentioned in the beginning. So as a worker, you are the supply side of the labor market. You are looking to sell your labor, and the higher the wage, the more hours you are willing to work. Law of supply: as wages rises, quantity of labor supplied rises, and labor supply curve is upward sloping like a normal supply curve. The labor supply curve is also upward sloping. As the wages of stylist rises, more people willing want to work as a stylist, and as they will want to work longer hours of work. So by this way we see that the supply curve is upward sloping. Now the demand, who is demanding that labor? The employer or the business. So who demands labor? Businesses, and businesses are on the demand side of the labor market, and the lower the wage, the cheaper it is to buy labor. So law of demand: when it is cheaper, quantity demand rises. When labor is at a higher wage, so it's going to be less demanded, and that's why the demand curve, like a normal demand curve, it's downward sloping. So we see here as well, like it's a downward sloping. In a perfectly competitive labor market, you are one of the many employers in the market, and there is a prevailing market wage, which is 12.5 if it is a perfectly competitive market. But the labor markets are not perfectly competitive because of the intervention from the government as a minimum wage requirement. So that's what we want to say. So if you pay less than 12.5, no one will work for you. That's from this analysis of the demand and supply. Workers can earn 12.5 elsewhere. So if you pay more than 12 point, why pay more? You can hire all the workers you want at 12.5. So there is no logic to pay more than the market price. And at the market price, you can get as much as you want. So employers pay workers the market wage when markets are perfectly competitive. So how many workers do you hire? So at 12.50 per hour, how many hairstylists should you hire? Or how many hours of labor should you hire? Apply the core principle to answer the question. That the principle is that we want to equate the marginal benefit at the marginal cost, or the marginal revenue or the marginal cost. So that's marginal principles break how many question into a more one more question. Should I hire one more worker? So cost benefit principle, does the marginal benefit exceeds the marginal cost? If yes, then do it. So marginal cost of a one more worker, the additional wage you must pay this worker, and the marginal benefit, that the revenue, extra revenue you can get from extra stuff they produce for you. So this is called as a marginal revenue product. And we all know that we have to produce up till the point where marginal revenue is equal to marginal cost. So marginal revenue product measures the marginal revenue from hiring an additional unit. And we can see this marginal product of labor multiplied by the price of the product, that is going to give us marginal revenue. So marginal revenue product, how we calculate? Marginal product of a labor multiplied by the price at which we can sell that product is our marginal product revenue. And marginal product of a labor, the extra production that occurs from hiring an extra labor or an extra hour of labor. So one more hairstylist allow you to provide 35 more haircuts per week at a $20 per haircut. So what will be the marginal revenue product per labor? So we can multiply this 35 with $20. So we got it around a $700 revenue from this additional worker. So the marginal revenue product of labor is 35 into 20, and we see it's 700. Cost benefit analysis, as we mentioned, we have to see this is a marginal product of labor, marginal revenue product of labor. Now we have to see marginal cost of labor as well. So marginal cost of a one worker, an additional wage you have to pay this worker, and the marginal benefit we already discussed, that's a marginal product, marginal revenue product of labor, that is marginal product of labor into the price. So the rational rule for employer is hire an additional worker if the marginal revenue product is greater than equal to the wage that what you are paying. In other words, hire another worker if the marginal product exceeds the marginal cost, and hire additional workers until wage is equal to marginal revenue product. Now here is a case like we are presenting number of hairstylists we are hiring 1, 2, 3, 4. Marginal product haircut per week 40, 35, 30, 25, and 20. So these are the haircuts that each additional worker can produce. Like if we are hiring the second worker, second stylist, then we have a haircuts. Then we can calculate the marginal revenue product of labor by multiplying the hours with the price, and price is $20 per haircut. So we see here 800, 700, 600, 500, and 400. Wage for the stylist is 500 per week, that is fixed. So 500, 500, 500. So based on this, we can see that where it is equal. So if I add this one there, so we see that we have to hire 4 stylists. They're gonna produce the fourth one is gonna produce 25, and by this way the marginal product revenue product of this fourth labor is 500, and the cost is also 500. Now we have to see that how much is the profit at that point. So we can see that the profit is 4. Number of hairstylists are 4. Total output is 40, 75 because we add up like 40, 75 because 35 is adding by the second one, and then 30 is added by the third one is 105, and then we added so it's 130. So we see here 130 haircuts. 130 multiplied by 20, that is going to the total revenue. 20 multiplied by 130 is 2600. Total cost is how many stylists we are hiring? Four. Wage is 500. So 4 multiplied by 500 is as 2000. So by this way we have a net profit, or the profit gain we are getting is 600. Below this point we see that it is 3, 500, 600, and after that if we hire one more as well, so we see that it is 500. So this is the ideal point where we can make maximum profit, or the maximum revenue. So does the rational rule for employers maximize profit? Following the rational rule for employer, you hired 4 stylists. They result in the output of 130 haircuts. Total revenue 26. Total cost is 2000. So the profit is 6. Now we see that hiring 4 stylists also allow you to maximize your profit. So conclusion, the rational rule for employer maximizing is your profit. So rational rule we have to apply. The rational rule for employer in a competitive market: hire additional workers until wage is equal to marginal revenue benefit. So if wage is equal to marginal revenue product, then your labor demand is your marginal revenue product of labor. And we see that labor demand summarize the wage at which you will buy each quantity of labor. So it's a downward sloping. So if we want to hire one more labor, so it's going to be the wage is going to be decreased. So the wage you are willing to buy each quantity of labor is informed by the extra revenue from the extra stuff this worker produced for you. So thus the marginal revenue product and the labor demand curve are one and the same. So marginal revenue product and the labor demand curve are same. It's going to give us a there is no difference. Like in normal situation we have a downward sloping demand curve, and the marginal revenue curve is below the demand curve, but here we are saying that it is the same. It is the same. So the interdependence principle and shifting labor demand. So how the labor demand is going to shift, right or left? The interdependence principle says that everything is connected. Your best hiring decision depends on factors beyond wage. It also depends on outcomes in other markets. When economic conditions change, so might your hiring decision change. And these are the four factors that can shift the labor demand curve. Change in demand for your product. If the demand for product increase, so we need more labor to produce that. If the demand for product decrease, we need less labor to produce that, because we want to reduce our production. We have to lay off. So this is the way that is going to shift the curve from right to left or left to right, depending upon the demand of the product they are producing. So it means their profession, their specialties, their advantage of that. Change in the price of capital. So change in the price of capital works in a two-way. One is that if the capital is getting cheaper, capital is getting cheaper, so what they do? They hire more machines and try to replace as much as possible with the labor. So labor demand go down. But it also works like this, that if the capital comes become cheaper, so there is a chance that the firms are expanding their businesses, and when they are expanding their businesses, they need more labor. So it works in a way that the change in the price of capital can work as a substitute in case if we need a machine that replaces the work, and it also can work as a complement, like we need more labor if we need buy more machines. So that's the way that it works. So it depends on the nature. Better management techniques and productivity gains. So if we utilize good management skills and scheduling and all these things are doing so effectively that we need less labor. And definitely if the productivity of a worker which is already working is increased, so by this way we need less labors. But there are some factors which are non-wage or non-monetary or non-financial factors that can affect the demand for that products. Sometimes the government give subsidies or subsidized loans for the or businesses, and we observed this during the COVID period, and that the government support to keep the labor demand intact, not to lay off more people, so that the recession become more severe in those hard times. So these are the things that also affect the or tax benefits. So when you hire a worker, you pay more than just their wages, and these payments are in terms of health insurance. Firms buy health insurances on top of the available government insurances. Retirement benefits, the government, the firms are contributing, the employee also contributing towards their retirement benefits, but the firms are also contributing. Paid days off means that the people enjoy holidays with the full payment, or some vacations on with the full pay. Employers pay taxes for each worker. So there are some cases in which the employer has to pay a taxes for their employees. Contribution to social security, that is also one of the way that employer contribute in the social security. If any one of these non-wage cost rises, labor demand decrease, and if any one of these non-wage cost falls, labor demand increase. So these are also, so we just discussed that these are the four ways that going to shift the demand curve for our labor. Now, in the second part, we focus on the supply side of the labor, and please stay tuned to go to see our second part.